Hello and welcome to Options Guide TV. My name is Brian Overby. I'm the author of the Options Playbook, and I'll be your host for about the next 25 minutes here on Options Guide TV. Today is Fundamental Friday, and we're going to look at buying call options. Now, we've already done a trade in Apple, and we're going to move on from Apple. We have a fairly convoluted position in Apple in that we actually bought the underlying stock. We bought a put as protection around earnings. We sold a call against the position. We rolled that call, but that call is still live inside the portfolio inside tradier.com. So with that mentioned, today we're going to go in and look at doing a trade in NVIDIA. So we're going to move on from Apple and we're going to look at NVIDIA, and we're going to talk about what option contract we want to buy. So now on Apple announced earnings, and they, one second here. Apple announced earnings, and when they announced earnings, we decided to come back and actually do our trade to add to the position, right? So Apple was a $300 stock at the time. We bought 100 shares. The stock is now moving up. It's right around 310 at this point in time. But we had the Apple position on. We protected it. We then said, okay, we'd like to get long Apple after their earnings report. And when we did that, we actually came back and looked at buying a deep in the money call as a surrogate for buying the stock. This is going to be something different today. We're going to look at speculating on options, and we're going to talk about the different degrees of speculation by looking at different strikes that we may buy around NVIDIA. Now, with that mentioned, I got to give you a quick note where options involve risk. You should read the characteristics and risks of standardized options if you're going to trade options. We're going to use real examples today. They're not meant to be recommendations or advice. Fundamental Fridays is all about education. Okay. My name's Brian Overby. You can follow me on x.com at Brian Overby. And my book is called The Options Playbook. So here we go. Let's back out here just for a second. And we're going to pull up the tradier.com dashboard here. And inside the Tradier dashboard, let's start by just looking at that Apple position a little bit. Let's start by, here's our 100 shares. We sold a put just as a cash secured basis. We said that if the stock came down to 290, we'd be willing to buy more. And that's our put option that we had on. We sold a call. We're at 310. We got a lot of days remaining to expiration. The stock is bumping up against the 310 level. That makes it tough. So we got to decide what we want to do with that position. We'll come back to that. And then we also bought the deep in the money call option. So this is what I want to highlight here is that with Apple at $309, we bought it right after earnings. So the stock was right just over 300. We bought the 250 strike call. We went way deep in the money. We went all the way out to October 16th. That position is doing really well. We're up 46% on that position. Everything's doing well except for the call because we're short on that and the stock is bumping up against it. But that just means that we're going to take Apple, our 100 shares. If it gets called away at 310, then we sold it at 310. We're just going to sell it at a higher price than we bought Apple at. So far, we're up 15% on Apple, and that's just before their earnings report. We put this whole position on, and we are our gain on the underlying is $4,000. Now, this is supposed to be a learning situation here, and that's what we're looking into. Is if we have stocks that we like, if we have stock positions in our account, how can we use options as they're first intended as to enhance the portfolio, to provide some protection, to generate some income? And then if you want to, you can look at options to try to speculate and try to add leverage. Now, today, we're going to do a little of both. We're going to focus on NVIDIA. And so many people, and I wrote a white paper on the top 10 mistakes of options. You can find the top 5 mistakes on optionsplaybook.com in the in the additional information section at the end of the book or on the website. And it talks about one of the biggest mistakes that beginning option traders make, and I think I highlighted as the number one mistake, is only being focused on buying out of the money option contracts. In other words, you come in and you say, okay, I like to buy a stock. Apple's a $310 stock. It's an expensive underlying. Or in NVIDIA, who has recently announced earnings, and we're trying to avoid earnings. So, and I'm going to type in that symbol right here. Oh, wrong symbol. And we have a $217 stock. And if we're going to trade that underlying, and we're looking at NVIDIA, a $217 stock, why not buy the cheapest option? Why not buy as many as we possibly can? Because that's the concept that comes from owning stocks. As a matter of fact, I know even a lot of beginning stock traders don't want to spend, they want to be able to buy 100 shares of the underlying stock. So they don't want to buy a stock like Apple that's $300 or NVIDIA, because you're talking about, if you have a $300 stock, you're talking about $30,000 to be able to buy 100 shares. And people are like, well, I can't buy 100 shares, so I'm not going to buy Apple. And that is just fundamentally wrong. You're better off sometimes buying 1 or 2 shares of a solid company than trying to speculate on a lower price company and be able to buy 100 shares of it. So that's the approach as far as Apple is, or as far as beginning option traders. They like to buy the out of the money option, not understanding the pricing mechanisms that are in the options contract, and they like to do it because it's cheap. You sound good at the cocktail party. You can say, I own 100 of those NVIDIA call options. It doesn't really matter because the stock's not going to get there. You went way too far out of the money, and you need the stock to move way too much in the short term in order to make that a feasible trade. So let's go to the option chain and let's add a position. We're going to get away from Apple, and we're going to add a position in NVIDIA. Now, why am I picking NVIDIA? Well, we picked Apple a lot because if you go to just in general, a lot of clients at Tradier, some of the biggest holdings are in Apple and NVIDIA. So I like to talk about stocks when we're doing the education section on companies that a lot of people may own. So we're going to look at buying a call option. And the most important thing to look at, in my mind, well, you have to determine, you got to do your research. You got to decide if you want to be bullish on a stock like NVIDIA or on Apple or whatever your underlying is. And then we want to go to the expirations. Now, the way that I think of out of the money options, as far as speculation is concerned, is going out further doesn't necessarily hurt you. You can't buy as many, but your biggest battle on buying out of the money option contracts is time decay of the option. Every day that option lives and the stock doesn't reach the strike price is like an ice cube melting in the hot sun. You're having that evaporation of that water come on. That evaporation is actually time decay in your option contract. So we're going to start out at 90 days. And I'm going to focus on something, and we're going to kind of jump back and forth here on the option chains. But right now we have NVIDIA trading at $217. So everything out of the money is above $270. So inside the trade your option chains, you have 3 different choices across the top. You can have all, you can have calls, you can have puts. We're going to focus on the calls. I basically keep it on all the time, even if I'm dealing with calls. And then over here on this side, these are puts. These are the strike prices down the middle. So we got the stock at 217. So the 220 is out of the money. The 215 is in the money. And that's highlighted by the blue background here on the chains. In the money are blue, out of the money are white. Okay. Let's look at the 250 strike call. We're still getting fairly expensive, right? Like if we want to get all the way down to a call option that is, I guess cheap relative, and we'll go all the way out to the 270 strike call, and we're going to click buy here, and then you hit send to ticket. And now we're going to take a peek at the analysis at the profit and loss graph. And here's what the issue is that if you buy this option contract, here's your profit and loss. This green line that I'm highlighting here is the profit and loss as of right now. As expiration approaches, though, so right now, if we do this trade and the stock goes up 1, well, let's make it a significant move, right? So we'd be paying. Let's click this. We never enter, and we've mentioned this more than once. We never enter market orders when we trade options. We have a 375, 380, 385, a fairly decent market for an options market. I'm going to hit 380, which is right in the middle. I'll even put the 80 cents in here. So that's $3.80, $380 is what it would cost to buy that one option contract. So our max risk on the downside is going to be $380. If we, they're saying 385. So let's go 85. Basically saying that we would be buying it on the ask, and that's our max loss. If every day that erodes and we get all the way up towards that strike price, this line will eventually start morphing into what it looks like at expiration. This is the profit and loss as of today. You'd be up $1,111 if the stock shot up to $257 and some change. But at expiration, you would be at zero. Your profit and loss would be minus $385. So if it happens today, you're up $1,176. If it happens at expiration or closer to the expiration date, you're down $385. And this is what's tough about buying out of the money calls. You can be right on the direction and still lose money on the trade because you were wrong on the timing. And we're even looking at a 90-day option contract. So if I'm going to speculate and buy an out-of-the-money option, I'm going to give it time. I'm going to buy less of them, and I'm going to, instead of buying 10 $1 options, I'm going to look at a longer term option and buy $3.90 options, right? The market's moving right now, but that's where the asking price is at, mainly because of what I just showed you as far as time decay is concerned. I'm willing to pay for more time. I don't have to use all the time, but time decays at an accelerated rate as options approach. And then on top of it, I want to highlight something, and we talked a little bit about this, and we'll probably go into more detail on Delta, but we have inside the basic option webinars, which I'm assuming you've seen by now. You should have opened up your Trader account and get access to those 4 fundamental videos. In one of the videos, we talk a lot about Delta. The Delta tells you how much your option should move relative to a 1-point movement in the stock. So if the ask price is $3.90 and the stock goes up 1, your option contract should go up by 17 cents in theory. Now that number is dynamic, just like your option price is. So it will change with every 10 or 15 cent move. But in general, that's the theory. So this delta is 17, meaning that we're going to, on a $3.90 option, 20 cents is a good percentage move if you get a 1-point movement in the underlying. Every day that goes by, though, every day that goes by, you get less and less delta. Okay. So if I'm on an out of the money option contract, so hang with me here. We're at 91 days. Let's cut the time in half. We're at 385, and I'm going to write that down real quick. Of course, my pen fell on the floor, but I'm going to write this down real quick. 385. And let's cut the time in half on this option contract. Let's go down to 45 days or somewhere close. We got 41 days. We're going to stay on the 270 strike. Now, remember this right here. We're going to stay on the 270 strike. Now, wow, I guessed it would be about $1, but that was pretty good. I didn't expect it to actually be $1. So the asking price here is $1. But now let's look at the delta. We cut the time in half, and the delta went to 0.06. Still, on a percentage basis, that would be a fairly significant move if you bought this option. But there's two things to glean from this. If I were to buy this option to start, I can buy a lot more. If the stock goes up, I don't get a lot more movement in my underlying. I get a lot less movement in the option contract price, not the underlying. If I get the movement in the underlying, I get a lot less movement in the option contract price. And that's because the delta says so. The delta helps you develop realistic expectations. This goes up $1. Your option contract is going to go up 6 cents. And now you only have 41 days for this to happen, for that movement to happen. If you cut that in half, let's say the stock still doesn't move, and we go down to 20 days, it even gets uglier, right? So we're at the 270 strike one. So that one was $1, amazingly. And then let's go all the way down to the 20-day option contract, 21 days out. We're going to stay on the 270 strike. Now our option contract is trading for 30 cents, and our delta is 2 cents. And the delta is just basically reflective of what are the odds of it getting to your strike? What has happened? And here in this instance, they're saying that probabilities are really low. The option's extremely cheap. You can buy a ton of them now with the same amount of money that you could buy 3 of the longer term options. And you can buy a lot of them, but the marketplace says go ahead and have them, because we don't think that NVIDIA can go from 217 all the way up to 270 over the next 21 days. That's what the marketplace is telling you. So don't just look at the option and say, well, it's the cheapest, let's buy it. Look at the option and say, well, what is the option saying about the marketplace? The marketplace is telling you that this stock is going to have a real tough time, and I'll just even do the math on it. We'll say 53 points, right? Okay, so we're talking about 53 divided by 217, that is a 25% move. 25% move over the next 21 days. And by showing you this delta and showing you this price and offering that up to you, the marketplace in general, marketplace in general is saying to you that there's a very low chance that it's going to get to that price. So, another way to look at this too is, let's say the stock moved half the movement in half the time. So let's go back to our 270 90-day option contract. And we're at 270, and here's our option. 375 by 385. Now, let's say it moved half the distance in half the time. We'll call it 90 days. We'll say 45 days. Okay. In 45 days, the stock moved 25 points as opposed to the 50 points, right? So it moved 25 points in 45 days. I have a question for you, and I want everybody that's watching on Fundamental Friday, I want you to think about what your answer is. So I'm asking it slowly so you have time to think. If we bought the 270 strike call, and in 45 days, the stock moved half the distance. So in half the time, it moved half the distance. What would the 270 call be trading for? What would be your best guess? Nothing else changes. Implied volatility doesn't change. Nothing else in the marketplace changes. No news, no anything, just everything stays the same. But it goes half the distance in half the time. And if you want to, you can let us know in the chat box. I'm happy to play along if you're happy to play along in my reindeer games. The answer is that it would be trading for about the same thing it is right now. And it has everything to do with everything that we've just talked about, in that if it's 390 right now, and you think about the marketplace assigning this price is basically the probability of the stock reaching that strike. That's one way to, it's a very generic way to say it, not exactly accurate, but it fits. It works. If this is $3.90 on the ask to buy the 270 call with 91 days remaining, if you cut that in half and you make it go half the distance, the odds of it getting to the strike haven't changed. You lost half the time and you went half the distance. So ideally, on a 45-day option contract that is trading 25 points higher, you would be basically the same price. And think about that. Think how disappointed you'd be as an investor if that happened. If you wait 45 days and you get this same type of movement and you basically break even on your option contract. So what's the moral to my story? If I'm buying out of the money options, I don't mind erring on buying more time than I need. And if I buy more time on the out of the money option contracts, I also want to have a plan to get out quicker. I'm not going to buy a 90-day option with the plan of holding it for 90 days. If I'm buying an out of the money options, it's because I think something happened. In other words, either we got some really good news and I'm trying to join in on that news, or I just saw something in the chart. The Fibonacci ran into the Bollinger Band and it hit the moving average and it did all of this. Now in NVIDIA, the big news, I guess, and a lot of people were already speculating on it, is the Jensen Huang went to China, and they're hoping that they'll open up the markets and that they'll be able to sell some chips over there to the Chinese. And so with that said, that is the speculation. That might be a reason why I might buy an out of the money call. But he came back, no news hit. We don't know what's going to happen, but maybe I get out. Why? Well, the stock moved a little bit on the news. It was up a tad, and now I'm just going to get out of the trade. That is pure speculation. That is pure, you're using options to try to guess on an event. You're using options because you saw something in the chart and you're hoping for a shorter term move. And now I'm going to go out further in time, not going to use all the time, and I'm going to get a decent amount of delta so that if the stock does move, my option contract actually does something. All right. So I'm not a big fan, obviously, of buying out of the money option contracts. I'm not saying there's not a time and a place, and I gave you many different scenarios where it is. But if I want to invest in NVIDIA, I'm going to look at going the exact opposite end. Let's stick on the 90-day option and let's go in the money. And then we're going to get more delta. We're not going to buy as many. So let's use this number that we came up with. We said that we were buying 3 option contracts at $3.90. Okay, so $1,170. And let's see if we can buy an option contract for that. Let's see what we can get. If we go down to the 215 strike, it's going to be too much that far out in time. Okay, let's cut it down. Let's go down to we'll go down to 41 days. And we can buy this option contract. So now we can go a little bit in the money. We can buy the 215 strike call. We're going to have to give up some time. We don't have as much time remaining. And I'm not as worried about that because I already have intrinsic value. I still need the underlying to move quite a bit. But the fact that if we buy this $12 option contract, as opposed to buying the 90-day option contract, we pay about the same amount, $1,245, a little bit more. We were $1,170 $70 to buy 3 of those. But I don't need the stock to get to 270 now. I need to get it to, if I ride it all the way to expiration, it would be 215 plus that $12. But because I got a real option contract and it actually has some intrinsic value here, stock is at 217 and I buy the 215. If the stock goes up 1, I can make 56 cents on this option contract. And I'm just doing that to compare apples to apples, right? I want to be able to say, if I were to buy 3 option contracts way out of the money, what's a decent alternative to buy an option contract that's in the money? And so here, that would be our option contract. Or I could even say, I'll go a little bit shorter. I won't go so far out of the money and I'll buy a just out of the money, but I still get more delta. I still need the stock to get to that strike, but I get represented with delta a little bit more. If I buy the $6 option contract, I could buy 2 of them, 41 days remaining to expiration. And now I'm going to get 35 delta in that instance. Still got to think about time decay though. I don't have any intrinsic value, and time value on this option contract is going to hurt. So every day that goes away, it's eroding because we're not in the money if the stock doesn't move and get all the way up to the 230 strike, which that's still a chunk of change, right? That's still 13 points before we get up there to make that an in the money option contract. Another way to say this, another way to think of this is, if you don't think it can get to the strike, then why are you buying the option? So if I'm speculating on a short-term out of the money option contract, so let's go and get this thing really cheap. Let's look at what a lot of beginning option traders like to trade. Let's go 10 days out, and 10 days out. We still got to pay we still got to pay $1 for 10 days out. Here's the 230 strike. So if I buy this option contract, if I buy this and I pay, well, let's make it $1. Let's make it simple. I wanted to get away from the half point strikes, but so the $232.50 strike call option, we're going to pay $1 for it. We can buy 11 of them with $1,100. So we can buy 11 of them. But if you don't think that in 10 days NVIDIA can get to 232.50, you got to be your attitude on these short-term options. Because if it doesn't get there and go beyond, as a matter of fact, the break even is going to be 232.50 plus 1. So $233.50 is what it would be if we paid the asking price on this call option. And if you don't think it can get there on such a short-term option, then don't buy it. That simple. You're not getting hardly any delta at all. Well, it's not bad. The delta is not bad. I'll give you that. It's 13.13. So if it does go up 1, you do have that chance to make 13 cents, which is a decent amount on your $1 option contract. But time decay is going to be ginormous. And if it doesn't happen, if you don't get that 1 point move on the first day, this is going to whittle away very quickly. And on the next day, it might be trading for 90 cents. And then the day after that, if it didn't make that 1 point move, now it's trading for 80 cents, or heaven forbid it went down. So you have a very fussy option contract that is not okay if the stock moves against you. Okay, so let's do the 2 trades. We're going to do, here's the moral to the story too, once again, is if I'm buying out of the money option contracts, I buy more time, buy less contracts. If you want to speculate, and that's pure speculation to me. So we're going to, in our paper trading portfolio, once again, this is about learning. We're picking a stock that everybody owns. We're picking a stock that has already announced earnings, so we're not dealing with the earnings situation. We'll look at a couple of them and we'll speculate on some earnings, just so that we can learn. But we're saying we're bullish on NVIDIA. We're going to look at buying that 41-day just in the money option contract and spending about the same amount to buy 3 of the out of the money option contracts, and then we'll watch them. So let's go in and do that at this point in time. We're going to go all the way out to the 40. Well, yeah, let's start with the 41-day. 41 days out. and 215 strike, $1,275. We're gonna, let's move this here, and we're gonna send that to ticket, and we'll get rid of this one. Come on. Need to get rid of this one leg. 1 second. My mouse isn't working today. There we go. All right, so in here, we're going to go at a limit price. We're just going to pay the ask. Now, if I was doing this in my regular brokerage account, not in the paper trading app here at Tradier.com, I would try to work it. I would try to get somewhere in the middle of this. I don't want to pay the full price. I don't want to go to the car dealership and pay whatever they say the price is, right? I want to negotiate a little bit. So $12.50 would be your starting point, which is the midpoint, and then give a nickel or two, say $12.55, $12.60. But right now I'm just going to put it in at $12.75. Remember, we never enter market orders ever when it comes to option trading. You always want to work it. The markets are a little bit wider. It's not like buying the stock NVIDIA where you're 2 cents wide on your bid ask spread, right? So now we're going to send this to the floor, but I want to get it filled. So let's send it. Order has been sent. Boom. Boom goes the dynamite. All right, now let's get rid of this one. And it's easier to do that. I don't know why I can't get rid of that leg, but we'll go back. And notice here, it actually says that we filled, and it's showing our position in the account. Now we're going to go out 90 days. Right here, 91. We're going to click on that. And we're going to buy 3 of the 270s. Send that to ticket, and we're going to make this a limit. We're going to hit even though we're hitting the ask, we're still going to put the limit in, and we're going to buy 3. So 91 days out, we're going to the August 21st expiration. We're going to buy the 270 strike call. We're going to buy 3 contracts, limit price of, well, we'll go $4. We'll make it simple. It moved on us. We'll go $4, good for the day, and we're going to send this to the trading floor. Trade has been sent. Boom goes the dynamite. Close this. And now we're going to go back to the dashboard, which is I love the simplicity of the Tradier site. This is having the order status right on top of the positions. Makes it very simple to see everything. And I like that they made that combo. Not a lot of firms will do that. And also on top of it, remember that if you're in the website, you can actually do something like this and open up the chains and have more than one page open, right? So we go back in NVIDIA, and we have our option chains on this, and then we have our positions right here. We fill both of them. So now inside our portfolio, inside this paper trading portfolio, I have a lot of positions that we put on Options Guide TV, which is a more advanced thing that I do Monday and Tuesday inside the Tradier Hub. But if we go down to the NVIDIA position, we're seeing both of our call options. We're long this call, and we're long this call. Now, we did pay the asking price, so we're going to get paid, or it's going to hurt us a little bit. So to start with, it's showing that we're down, because it's assuming that we bought it on the ask, and now it's saying if we sell it, we're going to hit the bid. So don't be scared by that. We would have worked it more if we weren't using the paper trading account and tried to get a little bit better fill. But this is our position. So now we're going to come back and we're going to look at that position, and we'll watch them, and we'll see how each option contract performs. Now we just need NVIDIA to go up, and that would be good. But even on the downside, we learn something from a losing position. And on Fundamental Fridays, it's all about learning. All right. Let's pop out for a second. My name is Brian Overby. I am known as the options guy here inside the Tradier Hub. Look below. If you want to trade right along with me, you can get access to a paper trading portfolio. All you have to do is sign up for a Tradier account, and you can ask questions along the way. I see quite a few in there, and we can address some of them. Good morning, Eric, and also good morning, Fresh Prince. Yeah, long weekend. On Monday, we don't have, the markets are closed, so I am doing an educational event this Monday that's going to be centered around skip strike butterflies. Very fancy. And let's see what Dougal says. Let's toss that one up. Yeah, never do market orders, and that is a real big theme, especially when you're a beginning option trader. Even if you see the market at $4, let's just make sure that they get you $4. I don't like sending anything to the floor where the market maker can just decide what that price is going to be. Well, obviously it's not that simple, but make sure that you get the price that you think you're going to get. So always put a limit order in when you're placing it. And I appreciate the comment. All right, everybody. Any other questions? This is what this is all about. Sign up for the account. We'll send you the 4 basic videos on option trading. Come in every Friday and trade along with me. Fundamental Friday, paper trade. Come on in, place the trades, watch them, live and learn. All right. My name's Brian Overby. My book's The Options Playbook. We'll see you next Fundamental Friday, and we'll build out a position in NVIDIA. Thanks for stopping in.